Okay, so many of you getting this video already know me, but I want to introduce myself because I wanted to go out to a much larger audience of people because I'm getting so many phone calls on this subject. So I hope it's going to go out. So let me introduce myself. My name is Mark Labradette. I'm the owner of Design Build Specialists. We're general contractors in Novato, California. And we've been doing insurance restoration work now for many, many years. Started in 1982 with the floods that occurred, and then we started doing large loss fires shortly after that. So I have a lot of history in fire reconstruction. And obviously the disasters that happen up north, everybody is concerned with their insurance and how it applies, as well as people who suffered loss, how their policies are going to actually be applied to them in the field, a subject that many are obviously very interested in. It's important you understand some history. Because prior to 1991, everybody had an insurance policy that had a face value limit to it, and they had this little rider on there called guaranteed replacement cost. So the Oakland Hills fire occurred in 1991. I saw their policy limits. The common number, $400,000 without fail. Rarely did I see someone that had a $500,000 face value policy, lived up there a long time. They had this little guaranteed rider on there. Well, what did that mean? That meant that the insurance companies routinely paid out $1.3 million, $1.5 million, $1.8 million, $2 million over, building these big custom homes up there because they had this rider. Well, insurance companies are very smart people. They said, we're not going to have that happen to us. So across the board, all the carriers changed their policy, and they took out, no longer is it guaranteed replacement cost. And now it has a cap on it. It's super important people understand how that applies and what that means. So I'm going to try to go through some, and I've seen also the trend starting in the early 2000. We started going on large loss fire losses where people were underinsured. That used to never happen. But starting in 2002, 2003, people would suffer these losses, and we'd have to walk away. People would be stuck because they would have nowhere near enough insurance coverage to pay for just minor fire. It was major loss stuff. It's not like total catastrophe you see up north now, but it would be, significant loss, and they'd be underinsured. So we're going to go over some basic terms to help people understand how it applies. So number one is face value. Now, the term I hear often with face value policies of people who suffered loss up north, I'm starting to hear people use 700, 800, 900,000 as figures for what their face value of their policy is. Now, people typically don't pay attention to this face value. What they're really interested in is premium. So they sit down with their agent. The agent tells them what the premium is. They're always wanting to save a few bucks, and so they want to reduce their premium. Super important to understand that in today's market, if your face value is not right, you are assuming risk. So if you have a premium for $500,000 and you suffer $1 million loss, you're assuming the balance of that risk. If you have a face value policy that's $250,000, a low premium, you're assuming more risk. If you have a face value policy that's way more than your home than you need, you assume no risk. So the insurance company is saying to you, you have to understand the value of what the face value of the policy you're buying, which leads to the question, what's it going to cost to rebuild my home if it suffered a catastrophe like Santa Rosa? We're going to circle back on that in a little bit. So face value is super important. Why? Because everything comes off of that. So your face value is $500,000, just to use a number so I do the math. So next thing you have this little part called replacement cost. Replacement cost on your policy is a rider, and it says that it's going to pay either 10, 20, 50% over your face value. So if you suffer a loss and the total, I come to you and I say it's going to cost $600,000 to rebuild your home, insurance company says, okay, great. We have a $500,000 face value. We have a 10% rider, or 20% rider, you hope, which gives another 100, so you're covered. If you only have a 10% rider, $550, you're 50,000 short. Now we start having to figure where else can we find money in your policy, and that happens now even with large losses, not total catastrophes. So the replacement is based on a percentage of face value. Your code upgrade in your ordinance is typically either a fixed sum or, again, a percentage of your face value. Code upgrade is super important. We're going to talk about how that applies in a minute. ALE, additional living expenses. That is how long they're going to pay for your additional living expenses while your home is being rebuilt. It's typically a year. A lot of the companies now are making it 2 years. But is that enough? Many people are going to get settled on actual ALE expenses of 1 or 2 years, only to find their home's not going to be rebuilt for 3, 4, 5 years. It's going to be a problem. So insurance companies are going to have to figure out how they want to handle that. Contents. Contents, again, is a percentage of the face value. So if you have, typical numbers are 40, 60, or 80. 40%, 60%, 80% above your face value. So if you have a 40% contents, you're insured for $200,000 of the face value for your contents. Now, a little side note on contents. Contents coverage, a $200,000 limit, is based on you actually replacing all of those contents. These people who suffered loss up in Santa Rosa, their homes are completely gone. They have to literally make a list and try to remember everything that was in their home, and they have to figure out what the price was for all of those items. And then the insurance company only gives you actual cash value, which is a third or half of what it is, until you actually spend the money and go and buy that item. So what does that mean? That means that it would behoove everybody to take an afternoon with a camera, walk through every room of their house, do a little panoramic view, and comment on the things that are in that room. How many suits? How many handbags? How many pairs of shoes? What type of bed? Where did you get the bed? What's the light? It's just basic comments. And then take that, put it on a thumb drive, put it in your go bag so that you have it, because it could prove to be super, super helpful if you ever were to suffer a loss. Even large loss fires, it's a big time problem trying to have people try to remember what they have in content. So that's the concept. So those are the main parts of your policy. So how does it actually apply? So here's a home that is up in right in the heart of up in Fountain Grove that burned down. It's a 4-bedroom, 4-bath, 3,683 square feet. It's listed for $965,000. It has a slight downslope. And it's a lot up in the Fountain Grove area of Santa Rosa. How much would you insure the face value of that home for? Most people are going to say $700, $800 because they're worried about the premium. Maybe they insure it to the value $900,000. Now, under most scenarios, that would be okay. Most losses you occur going to be fine. Even a large loss fire where half of this home is going to be completely gone, the whole inside is completely gutted, you're going to be properly insured. However, in a catastrophe event, you're going to be underinsured. And here's why. In a catastrophe event, when it's all burned gone and the foundation has had a large loss fire on it, high heat, melting things, the foundation is compromised. The concrete literally pulverizes and becomes mush. You got to tear the foundation out of the ground. Now you can see how the face value policy in these riders come into play. Super important. You're going to have, the home has to get completely rebuilt. You have to have, put glasses on. So what happens? Code upgrade becomes a significant issue because the foundation has to get replaced. This was likely just a typical T-footer foundation. Now it's going to have to be twice as wide, twice as deep because you're disturbing the soil. You're going to be drilling big old piers, 18-inch wide piers, 15, 20, 25 feet into the ground. Guess what? We live in earthquake country. Earthquake country has seismic requirements that require to tie this entire house together with metal straps and ties, and it's a big issue. You have sprinkler system that has to go in here. Well, a fire suppression system needs a water supply line. The meter likely has to be updated. One of the big issues that's going to occur up north, you have entire neighborhoods where the basic infrastructure is not ready to withstand a whole brand new development of new homes. It's going to be an issue. So you have code upgrade. So the face value becomes super important to pay attention to. Your contents, again, many people are going to have a very hard time figuring out what was in their home, trying to remember every room. So what's the moral of the story? The moral of the story is you have to pay attention to the face value of your policy. It is a key part of the whole thing. So you need to have an understanding. Now, if enough people respond to this video and like it, and I get enough feedback, I'll do a follow-up video where I'll do a case study of the exact same square footage of a home in the lower lands, a home halfway up that hill, and a home higher up in the hill. And what you're going to see is the amount of insurance required for those is drastically different, even though it's the exact same square footage. Why is that so? because the fit and finishes are all different. If the person lives in this home and never changed anything, it's one thing. But what if they've come in here and they've remodeled this entire space? They've spent $150,000 on a kitchen. They've spent, $30,000 for each one of their bathrooms. They've upgraded this home significantly. Well, guess what? If they want to rebuild it that same way, they're going to have insurance for that. Whereas somebody who lives in a lower land, in a flat lot, in a home that has foundation might be okay because the fire may have blew right over it. A lot of factors come into play, but I'm going to paint the story of what does it actually cost to build 3 different homes with 3 different fits and finishes in 3 different locations, even though they're the same or similar square footage. So get with your agent, talk about your policy, get educated on what these various things mean and how it applies to you and your work. Everybody has different needs, different circumstances, so you have to insure for your need. What is your quality of life? What is your standard of living? You have to insure for that, right? And everybody is going to be a little different. So send this out to your friends and family. Send this out to your world of influence. Hopefully you find it beneficial. If you want to call me, a lot of people are calling me. That can be found Design Build Specialist in Novato, California. And hopefully we'll all the construction industry will look to hopefully band together and really try to help these people get their homes rebuilt. And hopefully there's going to be a majority who are properly insured.